What's going on, everybody? Welcome back to the channel. In today's video, we're going to be talking about why do I look 10 years younger. I'm just kidding, but I already know half the comments are probably going to be Antonio, you look much younger. Yes, I finally shaved my face. It's been almost 2 years since I finally fully clean shaved my face. But it's not what today's video is about. Today's video is about the bear market. Are we in a bear market? And what am I buying during a bear market? I've gotten a lot of DMs, a lot of questions. Antonio, you always seem to time the market. I don't know how you do it. You must be from the future, or you must have a crystal ball. Maybe you have both. So make sure you watch this whole video to find out what exactly I'm buying during this bear market. What do I think this bear market is going? When will the bottom be? And my thoughts pretty much through the whole overall state of the market. If you like more videos like this, if you want to learn more about the stock market, the crypto market, make sure you subscribe down to the channel, leave a comment, leave a like. Tell me if you like more the full shaved or the beard, Antonio. Let me know in the comments down below. I already know a lot of people are going to be commenting about that. But first of all, let's talk about what is a bear market. A bear market is considered a minus 20% overall on the S&P 500. We had the shortest bear market, one of the shortest bear market in history last Friday, when the stock market hit a negative 20% and officially entered a bear market for about an hour or so. Then ever since then, he had recovered that and kind of got out, I guess, of a bear market. It was only down 19.8%. Personally, I think a bear market is considered when the market structure loses a bull cycle and goes into a bear cycle. That for me is what a bear market is considered. It's not a standard definition. The standard definition is a 20% decrease. But why has this been happening? And you gotta understand that the stock market cares about one thing and one thing only: quick, fast money. They want to make quick money as fast as possible, and that's it. That's all I care about. They're very short-term vision. Unlike you think there's a lot of long-term investors, most of the money in the market is actually short-term money. So the one thing the market cares the most about is interest rates. Ever since the stock market is predicted and the Feds have come out to raise the federal interest rate, has caused the market to come down into crashing down, very similar to how we saw in 2018. A lot of you guys probably have not been trading since 2018. But in 2018, we saw something very similar, almost a minus 20% drop into the stock market, which was caused why the Federal Reserve was increasing interest rates, and they were also doing buybacks. So about 50 billion buybacks every single month on their balance sheets. Now they're currently about going to be doing $100 billion, so twice as much as they were back then in 2018. Now, what caused the bear market to pretty much not fulfill or not really extend much longer? The Feds decided to not raise interest rates, to not cut back on their balance sheets, which then was delayed into 2020, and the Feds have pretty much just pushed the can down the road to where they're at right now, which they just can't keep doing that because inflation is still high. Inflation has not peaked yet. A lot of people were thinking that with the last CPI report, inflation was going to peak, but it did not peak just yet. It's getting higher and higher, and until we see signs of it start slowing down, the Feds will probably most likely not be able to stop the increase of these interest rates because they have to combat the inflation that's going on. Federal Reserve Chairman Jerome Powell has even come out saying that he will keep increasing the interest rates of 0.5% for the rest of the year, even though he knows most likely the stock market will hurt during this time. I do think we still have a bear market rally coming very near us. We saw a last bear market rally late March. We had a push to almost near the all-time high levels. We saw a really strong push very quickly where a lot of people got excited and thought that we were back. We had a really strong, about 2 weeks straight of just strong green days, which eventually came down crashing. Those are called bear market rally, which happen very often because they're a combination of long-term buyers starting to finally come in and start buying it up, and short sellers that have to close their short-term positions of a short sell, which caused them to buy back the shares again. Now, I do think we're going to be seeing something very similar very, very soon. June is the last month of the quarter, which a lot of money makers are going to be trying to push back the stocks back up because they want their balance sheets to look good, because they need their bonuses, kind of how it happened in March. March was the last month of the first quarter, and they need their bonuses. They need to go party. We all understand that the inflation is here, so they gotta make extra money. We all understand that we're in a bear market, so the alcohol consumption has gone higher, so they need more money to spend on alcohol and go to the clubs. That's how those money managers in Wall Street deal with this high stress environment. So on the short term, more than likely, I do expect us to have a pretty strong rally in the next month. Now that we're heading to the bear market, and you guys know I was one to say to sell the top in January. Not to pat myself in the back, I just gotta keep mentioning every single video I come out of here. I told everybody to be selling in January. I even posted a screenshot of I sold almost all my long-term portfolio. I'm finally starting to buy back. Yes, I finally did. You guys know I've mentioned this before. 390 to 400 level. I've currently bought back about $20,000 worth of stock investment 2 weeks ago. Then last Friday we didn't close below it, but we hit below that bottom where I bought. I pretty much almost timed the exact short-term bottom, but we did go a little bit below it. It's currently, I've only bought 3 things. I bought half of that $20,000 I invested was about $10,000 worth going back into Vo, $5,000 back in Apple. A lot of you guys might question, why did I buy Apple if we know Michael Burry is shorting Tesla? You guys have to understand, when Michael Burry comes out and saying he's shorting something, most likely he's been shorting it for some time, and he's just now probably going to be looking to starting to get out once he tells you guys. Keep in mind that everything you probably read on the internet, on Twitter that they announce is most likely much more delayed than what they did. Just like when he shorted Tesla in the 1200s and Tesla was in the 800s, he came out and said that he was shorting Tesla when he actually was shorting it much before he announced it and was actually very much up in his position, and just wanted to create some more hype to bring it down so he could get out. Remember this quote: if you cannot spot the liquidity, you will become the liquidity. Now, my last 5,000 was divided up between certain stocks that I personally like. It doesn't mean you have to follow the same. It was more of a mixed bag. Not a set amount of much, about $1,000 to $1,500 in each stock, which was Microsoft, Nvidia, Walmart, AMD, JPM, and Visa. If you do know me, you understand that $20,000 is actually a very small position for me, especially on a long-term account. And the main reason I did that is because I want to start a position, but I do think most likely the stock market will head lower. So my 2 options are either A, I have a started position and the stock market goes lower and I just keep averaging down, which I'm not mad about, as my first started position was about minus 20% on the overall market. Or B, we start going slightly up and I can average up into my position, which I also wouldn't be too angry about it. But now, since we're in a bear, almost a technical bear market for minus 20%, I'm happy slowly averaging back into my position, and I like to dollar cost average about once a month, or understand certain pivotal levels on the charts where I will have set limit orders. Other stocks I'm really interested in are stocks like Google. Amazon I'm staying away with. As you may know, I'm very short on Amazon and I'm not very bullish on the overall company, but we'll be picking some up if it does decide to go under $2,000 a share. Same with Facebook. Maybe if it goes under $140, $150 shares, I will be interested in picking it up. Disney, another one I might be interested, under $100 a share. Some other ones I'm pretty much looking to buy, of course, of a lot of other ETFs like Vo are other ones that I do plan to dollar cost average into. We also have to mention that guidance has not been great on a lot of stocks. We saw that last week when Walmart and Target reported earnings. Their guidance, which is usually when a company is supposed to reassure investors and explain them how the company is going to keep growing and want them to get motivated to keep investing, actually was negative. The earnings report was much lower than expected, which has caused pretty much the whole market to come down into more shamble last week. That's how we got that extra low on Friday. The main reasons of guidance of these stocks being down is inflation. Also, with main reasons why a lot of these huge retail stock companies have had negative guidance has been inflation, and a lot of imports and exports of goods have been slowed down due to a lot of things that's going on in the world currently. Now, if you're somebody that's like, you know what, screw Target, screw Walmart, I don't even shop at those stores, why do I care about it? It's because most of America does shop there, and if they have had negative reports, it means that most likely we're going to be in a recession. Inflation has been taking a hit, and if people are shopping less in those 2 big stores, most likely they're shopping less everywhere else, so showing that the most likely scenario the economy is in a bear market or in a recession. We also received some guidance on some tech companies like Snapchat, where today they announced that most likely they're going to be missing their earnings report, reason being a lot of ad spending has come down, which has negatively impacted a lot of tech stocks, because if Snapchat is going to be reporting negative earnings, most likely the rest of the companies are going to be reporting negative earnings as well. Now, we're going to be having a lot of buybacks coming up soon. Big companies like Apple, Amazon, Google, AMD are going to be buying back their own stocks, but that's going to be 4 days later. A lot of times they have a 4-day holdback period where after report earnings, they have to wait 4 days before they can buy back. So what I'm going to be expecting is most likely in the next round of earnings, most likely we're going to see a lot of negative earnings as expected. And 4 days later, we might start seeing a rally as a lot of those buybacks are going to be coming in place. But currently the state of the market has been in a negative scenario, in a bear market. I do think we'll still see a bull market rally, a strong rally potentially to even trick investors think we're going to be going to all-time highs. But I do think we have a longer term rally ahead of us. I do not expect us to get out of this until maybe February Q2 of 2023, but it's just speculation on my part. We still have a lot of time. A lot of things can change. The Feds can even come out. The FOMC meeting this Wednesday, they can come out and save the market and say, you know what, we're going to go back to 0% interest rates. I mean, nowadays, if you don't believe me that the market is just based on free money, free and fast money, just look at the PE ratios. Companies don't really trade based off their PE ratios, and the longer we've gone through the history of the stock market, the farther away we get from real stock value, fair value, to what people are willing to pay for it. Nowadays, it's been mostly just speculation and free money that's in the market. And we've been in a silent recession, I believe, in the last 10 to 20 years, even the stock market has gone higher. But that's all for me today. I hope you enjoyed this video. As always, leave a like, comment down below, subscribe. Let me know what's up with you. Let me know if you like the look. Let me know if you like the lighting. Let me know if you like this voice. I had to take a few breaks during this video just because I had to take a break from my voice, man. My throat was hurting. But I hope you appreciate me coming out and making this video still for you. And as always, peace.